Hello, hello. Good morning. I'm Kirill Ilinsky. I'm managing partner of Fusion Group. Welcome to our second episode of our educational Fusion series. Last time we had Ben and Joe from Vanguard who told us about basics of factor investing. Today we have a second session, second episode, uh, to speak about quantitative systematic strategies. We are very lucky to have today Toby Moskowitz, who is principal of AQR, one of largest alternative investment managers, and I'll talk about them a little bit later, who is also a professor of Yale University. He will tell us about the basics of systematic investments and as well tell us about how AQR thinks about creating alternative products. When people talk about alternatives, they usually think about hedge funds. Some of the oldest running, the most history of running of alternative strategies are managed futures. When people say managed futures, they think about CTA, commodity trade advisors. That's where historically managed futures appeared, when people traded different trends and mean reversion in commodity futures and then added bonds and then added equities and so on. And also part of the managed future strategy can be found within the systematic global macro, where once again funds take views on longer term trends in major asset classes. AQR is one of well-known investment management shops who specialize in running alternative investments. AQR was set up in 98. They now run more than $100 billion in their strategies, and one of their funds we are using in our portfolios. For us, talking about systematic investments is also special because that's how Fusion originally started. We set up in 2004 as institutional hedge fund, and our first product was credit relative value strategy, credit relative value fund, where we traded different risk pricing between different asset classes and different type of instruments, primarily nonlinear instruments, options and derivative products. This is also systematic trading, but it's different from managed futures, which we're going to talk about today, because managed futures are essentially linear instruments. Although James will speak, I asked James to speak about how even trading linear products can create nonlinear profiles. What we do, we analyze various nonlinear exposures and thinking about different value pockets which exist in that universe. And that creates way into managing the downside, creating long volatility strategies, and creating tail strategies which benefit from large market moves. And it's ideal addition to typical portfolios. We have managed futures in our portfolio because, as James will explain, managed futures also create not only sort of flattish correlation to the major asset classes, but actually because of capturing the longer trends, they create in large market sell-offs negative correlation to most of the portfolio, which are bonds and credit and equities. And that's the interesting and the most valuable feature of the alternatives and in particular managed future strategy. So without much further ado, I pass the baton to Toby.
So, hi everyone. My name is Toby Moskowitz. I'm a senior partner at AQR Capital Management, also a professor at Yale University. Been working with AQR for a long time. And I'm going to talk to you about systematic investing and with a particular focus on one of the strategies we do at AQR and that we're partnering with Fusion as well, which is trend following strategies. But let me start with just a brief overview of what systematic investing is, because there's a lot of misnomers about it. The way to think about a systematic process, and we're often called quants as well, because we use a lot of math and statistics, but the idea is pretty straightforward. We start with a basic theory of the world. In our case, it's economics, supply and demand, matter for prices, fundamentals matter, even some behavioral biases that we see from behavioral science matter for markets. We then build models out of that, test it with data, and then the data informs the theory, and we repeat. And this is what we do. We call it a systematic process because we have a theory, we let it guide us through the data then tells us whether our theory is correct or not, and we adjust it, and we keep iterating between those things until we arrive at something that we think is a pretty good description of the world, recognizing that we're always going to miss some things. So during that process, what we do is we try to systematically, in other words, through the model and through the data, identify pricing inefficiencies, measure it in a multitude of ways, and then try to express it in as many markets and assets as we can. So that includes single name equities, it includes futures contracts, macro assets, any place where we think the theory applies. The other thing that we do in a systematic process is we try to eliminate the emotion from our decisions and try to eliminate the errors from our decisions. And one of the things I'm going to emphasize is that we try to make judgments based on decisions, not based on outcomes. So let me give you an example of this process. We can start with a simple theory. One of my favorites is in behavioral science. It's called loss aversion. And I'm going to use sports analogies because I tend to do that. But there's this famous paper written by Devin Pope at the University of Chicago that looks at professional golfers and finds that they behave in a loss averse manner. And in particular, they end up putting for birdie much less successfully than they do for par, even if you're looking at the same distance from the hole, the same gradient, everything's the same. It's just whether it's par or birdie. And when you interview professional golfers, they all say the same thing, which is, well, I'm worried about, missing par and getting a bogey and being docked a stroke. But if I'm putting for birdie, I don't mind missing so much because I can always make par. Now, of course, this makes no sense because all that matters is you get the lowest cumulative score possible over the entire 18 holes. What you find with professional golfers is they leave birdie putts short, typically conservative, and they lead par, and they're much more successful on par putts. In fact, if they putted the same way for birdie as they did for par, they would make 3% more birdie shots than they do in actuality. And that's a form of loss aversion. So we can start with a theory like that. People avoid losses, sometimes too much at their detriment. We worry about losses much more than we do gains. So we'll start with a theory like that. We'll test it on some data, not professional golfers, but maybe the way people buy and sell securities, and maybe the way they trade stocks. And we do that in our process and take the other side of that bet, where we try not to succumb to that and even take advantage of what other people are doing when they're making those mistakes. Another thing that we do is we build models that capture connections in the economy. In other words, they capture economic activity, but we do it in a systematic process so that we can capture it in a systematic way. And I'll give you an example here. We've always thought of the world in terms of grouping stocks into industries. Industry is kind of an arbitrary concept. It says, do two firms compete for the same customers? That's when we say they're in the same industry. It's the same product market. Well, it turns out there's lots of different ways to connect firms. Take AQR, for example. We compete with other hedge funds for customers, but we also compete with Google and Amazon and other tech firms for talent on the labor side. And there's other firms that we're connected to on the R&D and the patent side and on the financing side. And some companies tend to appear in the same news together, or they're covered by the same analysts. So we've mapped at AQR about 20 different ways to connect firms, and not just firms, but also macroeconomic securities like currencies and commodities and fixed income securities. And when you can map things in about 20 different ways, as a human being, I can't keep that straight in my head. So I need a systematic process that writes it down, that keeps track of all these connections. And then we can do a bunch of interesting things with that. We can, for instance, trace information through this network and see how, if it affects one firm or one asset class or one region, how that's going to propagate to all the other securities. We can also make useful peer comparisons. If I'm comparing two companies, I want to know which one's cheap relative to the other. I want to compare apples to apples and make a determination as to which one's more likely to be mispriced and buy one and sell the other. And we do all of those things, but you really need a systematic process to do this across thousands of securities and with 20 or so different connections. That's a complicated process, but not too complicated for the computer to handle, with humans constructing what that network looks like. The other thing we do is we tend to make decisions. We see outcomes when we make investment decisions, but we tend to base our decisions on processes, not outcomes. Here's an example from basketball. I'm going to show you two shots in the NBA. And the first one is this shot here taken by Damian Lee. He's going to move to the left and shoot over an outstretched Paul George, and he makes the shot. That typically we score is 2 points, and the outcome was the team got 2 points. However, the process that led to those 2 points was terrible. Damian Lee took a long 2-point shot, which is a very inefficient shot in basketball, over one of the best defenders in the NBA. The probability of that shot going in is about 0.17, okay, 17%. He happened to make it. So we record it as 2 points. But for me, for our process, I will record that as an expected value of 0.17 times 2, or 0.3 points, 0.34 points. Contrast that with the next example, which is a wide open corner 3-point shot by Luke Kennard. He happens to miss. We record that as 0 points, but the process of that shot was excellent. That is a wide open shot for 3 points, not 2, for one of the best shooters in the NBA. In fact, he's the third best shooter of all time for 3-pointers. That had a 50% chance of going in. So that was worth 1.5 points in terms of the way I value it. The fact that he happened to miss is irrelevant to me. So I'm going to make my decision based off of that second example every time, and I never want to make a decision based off of the first sample, no matter what the outcome. And the reason why is because outcomes are determined by both skill and luck. We want to make decisions based on skill. The second one was a skilled play of much higher value. The first one was a terrible shot, but the fact that it went in versus the other one missed is irrelevant to us. And that's the systematic process that we try to adopt, making those decisions. Now, if you contrast what a systematic manager does, like us, versus a typical discretionary manager, there are some differences, of course, and then there's some overlap. Discretionary managers focus on best ideas. They rely on individual managers. They have typically very concentrated portfolios because you can only express those best ideas in a small number of places. A systematic process is model-driven. It's reliant on a systematic process where a single manager isn't that important. We have lots of different portfolio managers that can implement this process, and they're diversified. They benefit from doing this in hundreds, if not thousands, of different places with lots of different signals. And so both approaches are valuable, they're just different. The discretionary manager is betting on idiosyncratic risk. The diversified manager is trying to diversify, the systematic manager is trying to diversify away that risk, but both are after some of the same attributes, which is similar characteristics. We both like cheap, high quality assets that are improving. Those are the best companies, the best assets that we want to invest in. So trying to understand our investment process through this quantitative lens is kind of an important part of what we do. For instance, you could take our analysis and the signals and factors that we come up with through our quantitative process, and you can use them to explain some of the most famous investors in history. So we have a couple of papers on this. I won't do them justice. I'm only going to have a few minutes to cover them. But we took some of the best investors over the last century, Warren Buffett, Bill Miller, George Soros, and Peter Lynch, and we just decomposed their returns into the quantitative signals and factors that we use routinely at AQR. And obviously, we can't explain everything that they do, but we can explain a lot. You take Warren Buffett, for instance. A lot of his returns come from just basic market beta and an exposure to value, low-risk stocks that are high quality. That's something that we do too at AQR. We just do it in a diversified manner across thousands of stocks, and he does it with a handful. but you can see the overlap in returns there. There's also some differences, right? He has a little bit of unexplained return that we can't explain, and we have some unexplained return that he can't explain, but you see the overlap there. If you look at Miller's record, you see a similar thing. We can explain a lot of what he does with basic short volatility, market beta, and low risk. Soros on the macro space, you can decompose into momentum, as well as trend following, something we're going to talk about here at the end, as well as currency value strategies and momentum. And then even for Peter Lynch, who we have the hardest time explaining, we can still explain over half of his returns, in fact, 60-70% of his returns, using a combination of the quantitative tools that we use here at AQR. So the processes are different, but the outcomes, there's quite a bit of overlap too. Okay, so if we think about how systematic alternatives can add to your portfolio, one of the things, and there's a lot of alternative managers out there, one of the things that we try to do is make sure our funds do actually offer alternatives to traditional markets. Here's just a scatter plot of other funds in the same category, alternative hedge funds, where you can see what their correlation is to the global 60-40 strategy. The light blue are our funds that we're focused on here, and you can see we try to maintain low or even negative correlation to traditional markets. And that's the whole idea behind alternatives. That's an important feature. Another feature of our systematic process is not only to predict returns, but also to predict them in a different way than you get from just equity exposure or fixed income exposure. We want something that's truly an alternative. And one way to see this best, and this launches us into the final topic here of trend following strategies, which is one of the systematic processes we do here at AQR. If we were to take a look at how these alternatives can benefit your portfolio, start with the top 10 worst 6-month periods for the S&P 500. And here they are, and most of you probably recognize these dates because you lived through them. And you can see you would want something during these times that offsets some of that risk. Now, people often think of private markets as being a good diversifier, but private markets don't really offer much diversification during these tough times, which makes sense. There's still equity, for instance. So private equity tends to suffer during these times as well, almost as much as the public markets themselves. Well, what about alternatives? Well, if we started with just a generic equity market neutral strategy, and this isn't even our strategy, this is just the average from the hedge fund research index, you can see that an equity market neutral strategy, which is should be neutral to equity markets, actually behaves pretty neutral. It doesn't do great during these times, but it doesn't do badly. It's pretty flat, on average about 50 basis points. And so that's one set of alternatives that we offer. But there's others that actually help you during these tough times. And one in particular that we're quite fond of is trend following strategies. And trend following strategies have this nice feature that not only do they give you returns on average, but they do their best work. They give you the biggest returns during these down markets for equities. And you can see right here that when the S&P 500 is down roughly 16.5% over a 6-month period, trend following strategies are typically up about 12% during that time. And that's borne out time after time. In fact, if you look historically over the last century, you can go back to all the biggest down markets in equity markets, S&P 500 or global stocks, and you can see that, and you can see them listed here going back a full century, you can see that trend following strategies in the light blue here do very, very well during those times. The one exception was the 1987 crash, but in every other, and the recession of 1938, but it was flat then. The rest of the time, they're actually offsetting a lot of the losses you're getting in equity markets. That's one of the features that we love about trend following. So let me just wrap up in a few minutes here with some specifics of trend following and to introduce you to the trend following strategy. But to give you a few highlights, what we do is we take futures contracts and we exploit what happens in markets. Markets tend to underreact to information. So you see a couple of examples here, whether you're looking at commodities, government bonds, the MSCI World Index, or even the Japanese yen versus the US dollar, markets tend to exhibit trends. And what we try to do is we try to follow the uptrends and take the other side of the downtrends, a long-short strategy. And we've done that to great effect. And like I said, these things work well during normal times, but they work particularly well during these extreme down markets for equities. Okay? And why does this work? Well, we believe it comes down to behavioral biases, that people tend to underreact to information. They anchor, so people buy a security and then bad news comes out. They want to hold on to it until it comes back. And so that bad news slowly gets incorporated into prices. And on good news, people tend to underreact. They don't tend to buy more. They still tend to hold on to it. But if you follow those trends, if you exploit those trends, you can make good money over these investors that are, unwilling to trade when the news comes out. And we see that in all of these kinds of markets. Okay? And it matches up not just with price trends, but also fundamental trends. You see this happen in the fundamentals as well, whether it's growth revisions, whether it's oil price shocks, short-term interest rate revisions. You see this underreaction that happens in markets where prices don't fully adjust to that fundamental news. So putting this all together, how well does it work? Well, this is one of the, this is actually from a paper I wrote initially doing this more than a decade ago when I did the initial research on this with two of my colleagues at AQR. And we replicated the results going back all the way back to 1880. And I've never seen it work out this well. We're literally in every futures market across the world, whether it's fixed income, equities, currencies, or commodities, following the trend produces positive results. So trend following strategies do work. Obviously, they work in some markets a little bit better than others, and it's hard to know which ones. But the fact that these are almost all uniformly positive tells you trend following is a phenomenon that's been around for more than a century and one that is exploitable when you know how to trade it and how to measure it. And we could get into how we measure it, but as a simple example of just the returns, right? This is all back tested stuff. Let me show you the live returns. Our live performance on these strategies, if you take a look here, this is actually just the trend index, not our strategy. But if you look at the trend following strategy versus the global 60-40, it has yielded exactly what you would what I've suggested, which is it produces positive returns over time, and it does its best work when the global 60-40 strategy is doing poorly. And you can see that during COVID. You can also see it in 2022 when trend following had this massive upswing in returns when we know the S&P was down more than 20%. So it was a very useful thing to have in your portfolio at that time. And we've continued to do research in trend following. So in the products that we have, and this is the last slide, we not only look at price trends, but we also look at economic trends, as I've mentioned. We put together, it took us about 4 years, macroeconomic data on growth forecasts, inflation forecasts, monetary policy, risk aversion, and we created a bunch of economic trends that when we merge with the price trends, produce even stronger results. And in fact, if you compare our results to any other trend following manager over the last couple of years, you'll see distinct differences. The other thing we've done is we've implemented these trend following strategies in new markets, alternative markets like alternative commodities like Malaysian palm oil or South African yellow maize, these obscure markets where trend following works just as well. Many people aren't monitoring them. And so we continue to innovate by coming up with more data ideas to capture trends, as well as more markets with which we can express them. And that really sums up the trend following product that we have. So I'm going to stop there, and I'm going to answer a few questions. Thank you for your time.
Thank you for that presentation, Toby. It was very interesting indeed, and yeah, really enjoyed the sporting analogies, definitely. So I've got a few questions, if that's okay.
Of course.
So one of the questions I have is around the types of strategies that you use within the managed futures fund. So typically, managed futures use a combination of sort of mean reverting oscillator type strategies and then trend following or momentum type strategies. And these can have quite opposing characteristics. So if we look at the mean reverting sort of oscillator strategy, you make money during the short oscillations, then you lose out during the larger moves. So it's a short volatility, short gamma strategy, if you like. Whereas the trend following momentum strategies, you make money during the large moves, but you lose money during the short market oscillations, typically. So it's long volatility, long gamma, so opposite. So how do you think about the balance between these two different strategies? Is it dynamic, and does it depend on the market environment?
No, that's a great question. We tend to focus more on the long-term trends and less on the short-term oscillations. Our sweet spot is kind of in that intermediate kind of 1 to 12 month horizon where the trends work really well, and the short-term oscillations we find are harder to predict. Having said that, we do have some built-in reversion in the model to know when the trend is likely to reverse itself, right? Because the thing with trends is they work great until they stop, right? And you don't want it to reverse. So, but more so as an indicator of when to stop the trend, when the trend kind of becomes a little bit more neutral and you want to downweight it. But we focus more on that intermediate horizon. In terms of certain markets where that works better or worse, we haven't found much evidence that you can predict that. It's been hard to find environments where, I will say trend tends to work best, as we know, during extreme market environments. It's going to be a bit more, I would say a bit more stale or a bit flat during normal market environments, that we know. But I don't know whether those oscillations are really vary that much to that. Having said that, we continue to do research. And one of the things that we're looking into are looking at machine learning techniques to see, do we have the right balance between the short term and the long term? Are there things that we could find in the data that may change that? So I say that because our models are constantly evolving, and when they evolve, we make those changes. You'd obviously be informed of those changes, but we're always looking for new ways to improve. But that's where we are today, I would say, mostly on the trend side.
Yeah, that makes sense. Thank you. And then within the fund, you have sort of different allocations across different baskets. So you have across different asset classes as well. So equities, fixed income, currencies, commodities, and then some alternative markets, as you mentioned. And you allocate weightings across these different classes and baskets. And I assume that's done probably by looking at the correlation between them, calculating VARs, etc., which is quite correlation dependent. So during sort of periods of low volatility, correlations will be low and you'll look nicely diversified across asset classes. But during periods of high volatility, correlations go to 1. So how do you think about this? And do you forecast correlations, and how do you allocate across different asset classes?
Yeah, so we've spent a great deal of time. One of the things that I like to talk about as a researcher is everyone thinks of research as only focused on return predictors, right, and signals. But you just hit the nail on the head, which is predicting correlations and predicting volatility is very, very profitable, right? It's very useful to the portfolio. So now, the ability to do that is limited, but it's actually turns out easier to do that than to predict returns. So we have our own risk models that we built many years ago because they apply better to our own portfolios. Those risk models are built off of high frequency data, as well as a bunch of other proprietary information, where we're trying to predict when correlations might increase or decrease, and certainly when volatility is going to go up or down. Now, I will say for this particular product, because it's so diversified across so many different markets, I think we have something like more than 200 macro assets here. Correlations going to 1 is not really a concern. They can go up a little bit, they can go down a little bit, but they're so different, right? When you talk about just the heterogeneity in commodities itself, let alone that relative to fixed income, relative to currencies. Then you've got emerging markets, you've got alternative markets, and you've got equity markets. There's just so many assets that we keep adding to it that the issue of getting those correlations, close to 1 is just never going to be an issue. So something we manage that we're continuing to work on, but that's part of the process. I will say that over time, with technology and machine learning techniques and what we call adaptive signal weighting, we've gotten more flexible and more nimble, where when things change, we're able to react a bit faster. And I think that's contributed to our excess performance over the last 4 or 5 years. So that's been a positive. So yeah, we continue to get better, but it's something we actively monitor for sure.
Yeah, sure, thank you. And then another question I have is, and you touched on this in one of your slides actually, where you talked about some of the best performance of trend following strategies is when during market sell-offs. and therefore the fund can act as a hedge against long-term market downturns. And the strategy sort of is its peak performance when its trends go from bad to worse or good to better. So you're sort of capturing those long-term trends. Have you thought about adding maybe a tail overlay to the product or something like that to capture sort of sharp spikes in volatility as opposed to those longer trends?
That's a great question. That is something that I would say at the firm, we've considered sort of tail hedging or tail type strategies for all of our products. The research that I'm familiar with is that while they can help, they're very expensive. And so often what we find is, and they're expensive in two ways, not just in terms of the price you pay, but the opportunity cost you give up, right? So I think you sort of alluded to this earlier. If I want to hedge these large spikes in volatility, right, I can take a tail strategy, but half of those spikes end up being long-term volatility trends that I then miss out on for at least some chunk of it, right? And so that's always the balance. So currently we're much more focused on the trends because our ability to predict those is much better than to predict these spikes. But I would say it's a question that comes up, if not every year, every other year, which is, can we look at this one more time and see if there's a way to do it where we can combine it? But we're not quite we haven't figured out that it's worth it so far. Yeah, so that's been our conclusion thus far.
Okay, that makes sense. Thank you. And then one final question is more to do about the managed futures or CTA industry, if you like, and the expertise required to run the strategies. So I was looking at the total AUM in CTA strategies and its growth. So if you look at from when these strategies were introduced, sort of in the early 2000s up until sort of about 10 years ago, the AUM sort of growth is quite sharp. And now it's sort of reasonably stable around sort of 300 billion. But definitely we've seen a growth in assets in CTA strategies over the last 20 years. But then I was looking at a report by the NFA, which is the regulator for trading futures. And it said that NFA members are declining at a rate of about 3% per year. So why are we seeing sort of assets increasing and now becoming stable, but the sort of number of NFA members, so people involved with futures trading, is decreasing? So why aren't there any sort of new entrants coming into the market? What sort of barriers are they facing?
Yeah, that's an interesting question. I mean, I guess I wasn't aware of that statistic with the NFA. I'm wondering if that just means, it sounds like what it means is just although the assets are growing, it's becoming more concentrated, right? There's fewer and fewer players. I would say that's probably the natural process that you find in a competitive market, which is, managed futures became, as you said, very popular about 2 decades ago. There's this natural process where a bunch of people come in, and people that know what they're doing end up staying for a long time. Those that don't end up getting weeded out. And I bet you're seeing some of that natural process here, because it's now become a more mature strategy, a more mature industry. And I do think it's important, and I hope everybody can appreciate this, with the number of asset classes and contracts that you're having to manage, it does require a lot of expertise. I'm talking about the research side, but we have a whole trading arm that spends their day, every moment of every day thinking about how to execute those future contracts, how to roll them appropriately, create the most liquidity for our clients, and pay the cheapest cost possible when we trade. And I think that probably weeded out a number of would-be managed futures copycats. And so you really do have to spend time and energy and have the resources to know what you're doing and how to trade it. And I think that's important. So my guess is that's what we're seeing in the industry. Whether that continues or not, I don't know. It'll be interesting to see, but that's an interesting statistic.
Hi guys, I'm James, one of the portfolio managers here at Fusion. And I'm going to briefly just touch on the underlying strategies within managed futures and trend following in greater detail. So talk about how they actually work, how they make their money, how they lose money, and their pitfalls. So when we think of a trend, which is obviously the price moving in a certain direction, the key consideration here is the time window that we're looking at. So we're trying to capture these price movements and volatility over a day or over an hour, for example. So if we look at, for example, if we take a price which is oscillating around the mean every hour, then the intraday volatility is going to be high because there's lots of price movements. But then if we look at it through a daily lens, so the price at the beginning of the day to the end of the day, then the volatility is going to be low because the price is just oscillating around the mean. So understanding how the trend equates to the time window is an important aspect, which takes us back to our understanding of volatility and how we think about volatility. So if we look at the charts on screen in front of me, here the red line is the price, and we can see a clear trend, a clear upward trend on the chart. So trend following strategies typically place positions initially according to signals from indicators. So for example, this could be the price breaking above a particular resistance line or moving above the moving average or mean, which are shown here as this black line. So if we're thinking about a long position, so here we're going to be buying the asset hoping for a price increase. And then we'd place, so probably somewhere around here, and then we'd place our targets up here. And we'd also place our stop loss somewhere down here. So that's if we're incorrect and the price moves downwards, the stop loss will come into effect and sell the asset, so we get stopped out of the trade. And the stop loss can be configured in a number of different ways, depending on different time periods and other things. So in this scenario, how we make the money is that the price would move in the correct direction, so upwards in this case. So we're getting the trend correct, and then the trend will gather momentum for various reasons, such as herding and other behaviors, which Toby discussed earlier. And then you run your winning position. So here we're capturing and making money on these large market moves here. So we'll benefit from periods of higher volatility. And then if we go to the next slide, here we can have a different scenario. So we can have a scenario, instead of a long trend breaking out, we can have a scenario of mean reversion. And this is how we lose money in the trend following strategy. So instead of moving upwards, the trend continuing, what happens is the price can mean reverts and oscillates around the mean, as we can see here. So here, again, if we same scenario as last time, if we buy the asset here, what would happen is we'd effectively be stopped out of the trade at our stop loss below the mean. And again, we'd buy the asset up here and be stopped out down here. So we're buying high and we're selling low. So that's where we're losing money. So there's no large market moves. We're just oscillating around the mean in periods of lower volatility. So we're losing small amounts. And this is why trend following is a long volatility strategy. So we make money on large moves, as we saw in the previous slide, but we lose small amounts in these oscillating periods of lower volatility. So how do we manage this issue where if we guess the trend correctly, then we win, and if we get it wrong, then we lose? So what you do is you start by taking small positions initially when we're just beginning. So we're hoping, but we're not sure which direction the price will move in. We take small positions, and then as a position begins to win, we accumulate more and more in terms of size as the trend gathers momentum. So if we go back to the previous slide, so here we buy the assets, the price moves up, so we buy more, and as it continues to go up, we buy more again. So our position in terms of size is accumulating. And this is how we achieve our convexity or non-linearity in terms of our payoffs. So again, we're capturing the larger market moves, so we're benefiting from periods of higher volatility. And because our position is increasing in size, our payoff is increasing on increasing volatility, which is known as a long gamma strategy. So even though we're trading linear instruments, we can achieve non-linear payoffs. And at Fusion, from our background as derivative specialists, we recognize this as being equivalent to positions in options and options exposures. So trading these types of strategies is essentially playing volatility. And you can get the upper hand here by forecasting volatility. So you can forecast volatility for the next period and then amend your weightings to these types of strategies accordingly. So you forecast volatility, and then you take your forecast. If it's high for the next period, you'd increase your allocation to these trend following long gamma strategies. And if volatility is low, you'd move towards those oscillating type strategies. So at Fusion, we have models which forecast volatility for the next period, which we revisit on a quarterly basis when we rebalance our MPS portfolios. And one of the main benefits of managed futures and trend following strategies is that they have low correlations with other asset classes. But not only that, another key point is that they can work well in a defensive capacity, as the strategy has the capacity to generate outsized returns. And this is due to that accumulation feature where we're adding size to the position as we're following the trend. So, for example, in a long sell-off period, managed futures can generate an outsized positive return by following that downward trend. And I'll now touch on how we're utilizing the AQR Managed Futures Fund within the Fusion MPS portfolios. And as you can see here, we've got a menu of MPS portfolio ranges. And the ranges which we're currently utilizing the AQR Managed Futures Fund within is the Fusion Active range and the Fusion Proactive Planet range. And this Managed Futures Fund is held within our alternatives allocation. And when we select alternatives, we're ideally looking for strategies or asset classes which generate returns which are uncorrelated with the main asset classes, so equities and bonds, and therefore act as diversifiers within the portfolios. So on the screen here, we're looking at the same figures as we saw in Toby's presentation. We've got performance metrics for a classic multi-asset portfolio, so the 60-40 portfolio. And then in the middle, we've got the performance metrics for the trend following index. And then on the right, we've got the impacts of adding a 20% allocation to the trend following index to the 60-40 portfolio. And here we're looking at figures from January 2000 to April 2025, so quite a lengthy 25-year period. And a key point to note here is that we can see the correlation of the trend index to equities is very low at minus 0.1, which is exactly what we're looking for within our alternatives allocation. And then on the right column, we can then see the impact this has when it's included within the multi-asset portfolio. So the volatility is much lower due to that diversifier effect. And the Sharpe ratio, so the quality of the return is significantly increased. And then we can see the downside protection impact as well. So as Toby showed earlier, the returns of the trend following strategies are often the highest during market sell-off periods. And as we can see, the maximum drawdown figures are much improved for the portfolio when the trend strategy is included. So these are the effects that we're trying to achieve and why we decided to include the managed futures strategy within our multi-asset portfolios. And obviously our alternatives allocation is much lower than 20%, typically around 5%. But hopefully you can understand the impacts that we're hoping to achieve here.
Toby, James, thank you very much. Very insightful and also very engaging. We are lucky to have Toby today because usually it's quite rare to hear from people who actually develop the strategies who are able to talk about what we do in so clear, transparent, and, as I said, engaging and insightful way. So thank you very much. Thank you very much for watching. I hope to see you all in a month's time for our third episode. So thank you. Goodbye.